has this seasoned agriculturalist, Village Farms International, finally cultivated a durable, cash-generating machine in the volatile world of cannabis?
Or is its recent stunning surge to record profitability merely, a fleeting harvest before a return to barren ground?
We're going to unpack the compelling bull and bear cases for this company today. We'll dig into whether Wall Street's skepticism about their breakthrough quarter is warranted, or if maybe a true sustainable shift has actually occurred. Welcome to the Deep Dive. Today we're taking a deep dive into the fascinating transformation of Village Farms International, Inc., ticker symbol VFF. Our sources for this deep dive are a comprehensive analysis report from August 14th, 2025. It's packed with insights, financial data, market metrics, the works.
Right.
And our mission today is pretty straightforward. Extract the most important nuggets of knowledge to help you understand if VFF has genuinely reached a sustainable inflection point, or if this is just, well, a flash in the pan.
A key question for investors, definitely.
So let's get started. Chapter 1, Business Analysis. Let's unpack this. The report really highlights VFF's pivot. Decades as a quiet farmer of tomatoes and peppers.
Yeah, very steady, traditional agriculture.
Exactly. And then diving headfirst into the volatile world of global cannabis. So the central question for us and for investors is about the sustainability of that recent record profitability.
What's fascinating here, I think, is how they've leveraged their long-standing expertise in controlled environment agriculture, or CEA.
Right, the high-tech greenhouses.
Exactly. They've taken that know-how and transformed the company into a diversified, plant-based consumer packaged goods company, but with cannabis now as the primary focus. It's quite a shift.
So what does this all mean for their core business today? We're looking at a unique, vertically integrated model. The report breaks it down into 5 distinct segments. First, Canadian cannabis. This is their largest and most profitable segment, driven by Pure Sunfarms. They're generating revenue from domestic retail, non-branded wholesale, and importantly, high-margin international medical cannabis exports.
That export piece is growing fast, too.
Then there's U.S. Cannabis. This operates through Balanced Health Botanicals. It's currently a top 5 CBD brand, hemp-derived products.
Right, non-psychoactive.
But the key here is the potential. They're positioned with these massive high-tech facilities in West Texas, basically ready to flip a switch for the high-THC U.S. market once federal legalization happens. Huge optionality.
A massive strategic asset just waiting.
Next, Netherlands Cannabis. This is a new, rapidly growing segment with Leli Holland. They're one of only 10 licensed producers in the legal recreational cannabis experiment there. Revenue just started kicking in Q1 2025.
Early days, but very promising, being one of only 10.
Then you've got their legacy business, produce, VF Fresh. It's streamlined now, primarily supplying produce to a new joint venture, Vanguard Food LP.
So they haven't totally abandoned their roots, just optimized.
Right. And finally, clean energy. It's small, but provides a consistent revenue stream from a royalty arrangement converting landfill gas to renewable natural gas.
Interesting diversification, even if it's small. And the Q2 2025 earnings report, it really paints a vivid picture of this shift. Out of, $59.9 million in consolidated sales.
Yeah, just under $16 million.
Canadian cannabis was the powerhouse. It posted a 39% gross margin and $11.9 million in adjusted EBITDA. That really demonstrates the success of this strategic pivot to cannabis.
And their key products within these segments?
Well, for produce, it's still the Village Farms, fresh brand tomatoes, peppers, cucumbers, going to major retailers across North America.
Familiar stuff.
Yep. In Canadian cannabis, you've got Pure Sunfarms and Rose Life Science. They're focused on that everyday premium niche, dried flower, pre-rolls, vapes. Pure Sunfarms is actually the top-selling flower brand in Canada now.
Really dominant there.
Absolutely. For U.S. cannabis, it's Balanced Health Botanicals with the hemp-derived CBD products for now. And in the Netherlands, Leli Holland is supplying legal recreational cannabis to the coffee shops.
So connecting this to the bigger picture, their market position looks pretty strong.
It's formidable.
Yeah.
Pure Sunfarms is a Canadian cannabis leader, even globally significant, #1 in dried flower in Canada. They're a U.S. optionality leader, like you said, with those 5.5 million square feet of high-tech facilities in West Texas ready to go.
That scale is hard to replicate quickly.
Exactly. And they're pioneering their European presence, being one of only 10 licensed operators in the Dutch recreational market. That's a big deal
So, boiling it down, their primary value proposition is leveraging decades of scaled, low cost, sustainable CEA expertise
that they built up in produce.
to produce high quality plant based products, especially cannabis now, at a cost structure that newer competitors just can't seem to match. And here's where it gets really interesting in the industry analysis part of the report. Let's look at market trends. The global legal cannabis market is projected to hit, what, $444 billion by 2030? That's huge.
Astronomical growth potential.
There's a clear shift towards wellness products. And that price compression we've seen, about 32% since 2021, it actually favors efficient operators like VFF.
Right, the high-cost producers are getting squeezed out. VFF's efficiency becomes a major weapon.
Plus, the increasing demand for sustainability aligns perfectly with VFF's resource-efficient CEA approach. Competitively, they face the big Canadian LPs like Canopy Growth and Tilray in cannabis, and large greenhouse operators in produce.
Standard competition, but VFF seems well-positioned.
And the regulatory environment is absolutely critical. In Canada, regulations are apparently streamlining, reducing some compliance burdens.
Which helps margins.
In the U.S., the proposed rescheduling of cannabis to Schedule III, that would be a game changer for taxes, alleviating that painful 280E burden.
Huge relief. But, as the report notes, it wouldn't solve banking issues or interstate commerce limitations. Still a ways to go.
True. And the Netherlands market. Tightly controlled, only 10 licensed producers, which limits competition significantly for Leli Holland.
That structure really benefits the incumbents there. So this raises an important question. What about barriers to entry? What's stopping everyone from jumping into this potentially huge market?
Good point.
Well, the cannabis industry has incredibly high financial capital requirements. There are significant banking and capital access issues, especially in the U.S., due to federal illegality. And the regulatory complexity is just intricate.
A minefield.
Pretty much. These factors create a steep learning curve for new entrants and definitely favor experienced, well-capitalized operators like VFF.
And that brings us neatly to their competitive advantages. What really sets them apart?
Okay, well, first, brand strength. Pure Sunfarms is a best-selling, respected brand in Canada. That everyday premium positioning seems to resonate.
Solid brand recognition.
Then cost advantages. This is probably their biggest weapon. Decades of expertise in low-cost, large-scale CEA. Management even states it takes over 5 years for new large-scale operations to become truly efficient.
Wow, 5 years.
Yeah. VFF essentially skipped that painful learning curve by converting existing, already efficient produce greenhouses. It gave them a massive head start on costs.
Like starting the race halfway down the track.
Exactly. And finally, unique assets. Those 5.5 million square feet of high-tech greenhouses in West Texas are a strategic, hard-to-replicate asset specifically for U.S. federal legalization. It gives them a huge leg up on Canadian peers who would have to build from scratch. Plus, their vertical integration helps ensure quality and efficiency throughout the chain.
Okay, a very compelling picture on the business side. Let's shift gears now. Behind every company like this, there's leadership. Who is steering the ship at Village Farms? Let's move on to Chapter 2. Management evaluation. The report emphasizes stability and a long-term vision here.
Indeed. Founder Michael DiGiglio has been president and CEO since 1989. That's a 36-year tenure. Remarkable stability at the top.
Almost unheard of these days.
It really is. And his background is interesting. A U.S. Navy captain, a tactical jet aviator. It seems to have instilled a culture of operational excellence, precision, discipline.
You can see that reflected in their strategic moves. His track record shows foresight, recognizing the need for vertical integration in produce way back, and then, crucially, pivoting into cannabis in 2017.
And importantly, how he did it. He publicly stated they avoided the hype and foolishness and the massive cash burn that just plagued so many competitors in the early cannabis gold rush.
Smart. They also navigated crises. The report mentions intense pricing pressure from Mexican produce imports years ago, which actually forged their low-cost DNA, as they call it.
Trial by fire, making them leaner.
And more recently, that tomato brown rugose fruit virus infestation. They managed to secure a vendor settlement from that. Shows resilience.
Their communication transparency and ethical reputation also get highlighted. DiGiglio is one of the company's largest individual shareholders, owning about 8.71%. That's over $16 million worth.
Significant skin in the game.
Huge. And he's publicly stated he's never sold his founders' shares. That alignment with shareholders is powerful. They provide regular updates, detailed earnings calls with Q&A. Their strategy feels clear and consistent.
So, what about capital allocation? This is always crucial. How are they using their money? This is where it gets really interesting.
Good.
Investment in core business and M&A. That May 2025 deal where they privatized a chunk of their Texas produce assets. They got $40 million in cash and kept a 37.9% equity stake in the new entity, Vanguard Food LP. That seems like a savvy move, right? Monetizing lower return assets.
Absolutely masterful, I'd say. It strengthened the balance sheet significantly and freed up capital to reinvest directly into high-growth cannabis, like expanding their Delta 2 greenhouse. It wasn't just selling off the old, it was strategically funding the new.
And their M&A strategy.
Seems very prudent. Targeted purchases for specific capabilities like acquiring Rose Life Science in Quebec for market access, not just empire building for size. Very disciplined.
What about returns to shareholders? Share buybacks and dividend policy.
Simple story here.
Yeah.
No dividend currently, and they haven't paid one since 2009. No recent share buybacks either.
Which makes sense for a company in growth mode.
Exactly. It's appropriate. They're reinvesting cash for potentially much higher long-term returns rather than distributing it now.
Okay, now return on invested capital, ROIC. The report notes it's been historically poor.
Yeah, dragged down by the low-margin produce business and the costs of the cannabis transition. It takes time and money to make that pivot.
But there's a shift.
Following Q2 2025, FinViz is reporting a positive trailing 12-month ROIC of 3.24%. Now, that's still below their estimated weighted average cost of capital, or WACC, which is around 9.99%.
So they're not yet earning back their cost of capital on an annual basis.
On a trailing basis, not quite yet. But the trajectory is what's important. The investment thesis for VFF really rests on whether this ROIC can sustainably climb above that WACC hurdle rate. The operational leverage they showed in Q2 suggests this is now, finally, a realistic possibility.
Okay, that's a critical point. The potential is there, but sustainability is key. Let's dive into the numbers themselves. Next up, Chapter 3, Financial Analysis. Let's review the key metrics.
Great.
Market cap, as of August 14th, 2025, around $292.88 million. Puts them in the small cap category.
Relatively small, yeah, given their operational footprint.
Revenue growth trends look impressive. They nearly doubled annual revenues from $170 million in 2020 to $336.2 million in 2024. Strong top-line growth.
Can't argue with that trajectory.
But profit margins, that's been the weak spot historically. Volatile gross margins, consistently negative operating and net margins for years.
Until Q2 2025. That quarter was a dramatic shift. Consolidated gross margin jumped to 37.2%, driven by that 39% margin in Canadian cannabis. And crucially, they posted a strong positive net income of $26.5 million.
A huge swing from previous losses.
A potential turning point, definitely.
And free cash flow, FCF generation. After years of burning cash or being marginal.
They turned a corner in 2024, generated $10.3 million in operating cash flow. And that really accelerated in the first half of 2025, a robust $22.3 million.
So they're starting to generate cash internally now.
Yes, and analyst estimates project that to continue. Positive FCF of $6 million in 2025, growing to $20 million in 2026, and maybe $47 million in 2027. This strengthening cash generation is vital, allowing them to fund expansion internally.
Which brings us back to financial stability.
Exactly. Earnings consistency has been the major concern given that long history of losses. It makes Q2 2025 such a significant outlier. The whole investment thesis really hinges on this quarter being the start of a new era of consistent profitability, not just a one-off blip.
But their balance sheet looks like a definite strength.
It really does. Their debt-to-equity ratio is low and actually decreasing, hovering around 0.17 to 0.21. That gives them significant financial flexibility.
Very little debt pressure.
Right. And their current ratio is robust, between 1.92 and 2.65. That signals a very, very low risk of any short-term liquidity crisis. They have plenty of assets to cover liabilities.
And dividend stability is straightforward. No dividends since 2009, consistent with reinvesting for growth.
Yep. Now, valuation. From a valuation perspective, a traditional trailing PE ratio isn't very meaningful because of that history of unprofitability.
Right. Dividing by zero or a negative number doesn't help.
Exactly. However, their forward PE, based on analyst estimates, is around 16.37. That appears pretty reasonable, maybe even attractive compared to the broader consumer staples sector.
And the price-to-sales ratio?
The PS ratio is approximately 0.87, That's relatively low, suggesting the market isn't yet pricing in expectations for sustained high growth or profitability. It implies some skepticism still.
Which leads us to intrinsic valuation. What might the company actually be worth based on its future cash flows?
Okay, using the DCF concept, discounted cash flow analysis, which tries to estimate intrinsic value by projecting future cash flows and discounting them back to the present.
Adjusting for risk and time.
Precisely. An educational DCF model was built using conservative assumptions. It estimates an estimated value range of $3.50 to $4.50 per share for VFF.
And what are the key assumptions behind that range?
The model uses those analyst FCF estimates we mentioned, starting at $6 million in 2025 and growing to around $70 million by 2029, then assuming a conservative perpetual growth rate of 2.5% after that. Crucially, a discount rate of 15% was applied.
That 15% sounds high compared to their WACC of around 10%.
It is significantly higher. And that's deliberate. It's meant to account for the substantial regulatory risks, the market risks, and the execution risks inherent in the cannabis industry, especially with the U.S. market still in limbo. It builds in a margin of safety.
Okay, that makes sense. Acknowledging the risks in the valuation itself. All right, we've looked inside the company. Now let's look outside. How is the market feeling about Village Farms? Let's move to Chapter 4, Market Sentiment. What's the word on Wall Street?
Well, Wall Street seems decidedly bullish right now. The consensus rating among the analysts covering VFF is a buy or strong buy.
Pretty positive signal.
Yeah, and price targets range from $3.25 up to $4.50, with an average target of $3.75. That implies significant potential upside from the current share price.
And the news flow, has that changed?
It's turned overwhelmingly positive. That blockbuster Q2 2025 earnings report released on August 11th was the main catalyst. Headlines have really focused on record profitability and that 12% year-over-year revenue jump. It shifted the narrative.
So fundamentals are looking up, analysts are positive. What about technical indicators? Is there still significant bearish sentiment?
That's another interesting piece. Bearish sentiment measured by short interest is actually low and decreasing. It stands at just 3.88% of the public float. So not many people are betting heavily against the stock right now.
Okay.
And from a technical perspective, the chart looks strong. The stock is trading significantly above its 50-day moving average. That's around $1.24 to $1.28, and well above its 200-day moving average, which is sitting around $88 cents per dollar.
Which generally indicates a strong uptrend, right?
Exactly. Both short-term and long-term trends look positive based on those averages. So the market seems to be seeing a powerful confluence of bullish fundamental signals and bullish technical signals right now.
Interesting combination. Okay, let's move on to Chapter 5, Ownership Structure. Who actually owns VFF stock?
Well, institutional ownership is relatively modest. The report cites ranges between 12.15% and 19.76%. That suggests it might be a bit underfollowed by the really big generalist investment funds.
So mostly smaller or specialized funds.
Primarily, yeah. The largest institutional holders are mainly cannabis-focused ETFs. And while there was a slight net decrease in shares held by institutions overall recently, some sophisticated funds like Renaissance Technologies actually significantly added to their position.
Fintech. That's noteworthy. They're known for their quantitative approach.
Very noteworthy. But here's where it gets really interesting, I think. Insider holdings.
Ah, the management team themselves.
Exceptionally high, ranging from 11.03% up to nearly 18%. And as we mentioned, CEO Michael DiGiglio personally owns about 8.71% of the company.
That's a huge amount of skin in the game from the founder. A very powerful positive signal.
Absolutely. And what's fascinating here is the recent insider trading activity. It's been bullish. There was a net total of 250,000 shares purchased by insiders in the 3 months leading up to this analysis.
Purchased, not sold.
0 shares sold by key insiders in that period. Both CEO DiGiglio and CFO Stephen Ruffini were active buyers in May 2025, and this was before that strong Q2 earnings announcement.
Suggests they had strong conviction that things were improving fundamentally even before the market saw the results.
Precisely. It's a strong indicator of internal confidence.
And ownership concentration.
Also fairly high. The top 25 shareholders own about 22.12% of the company. This can sometimes lead to higher volatility, as fewer large holders can move the price more easily.
Right.
But it also often indicates a deep understanding and a long-term investment horizon among those key owners. They're likely not just trading in and out.
Okay, strong insider alignment, growing institutional interest from some smart players. Let's transition now to the potential downsides and the road ahead. Chapter 6, Risk Assessment. The report uses a SWOT analysis here.
Yes, it provides a good balanced view. Let's break it down. Strengths, we've covered these, but to recap. Low-cost production from decades of CEA expertise, vertical integration, that strong balance sheet, experienced and aligned management, and crucially, those strategic U.S. assets in Texas providing federal legalization optionality.
Solid foundation.
Weaknesses. The big one is the history of unprofitability. Q2 2025 was great, but the sustainability of those profits is still unproven against that long track record of losses. There's also a dependence on the very competitive Canadian market, and the report mentions past notes in their 10-K filings about material weaknesses in internal controls over financial reporting, something to keep an eye on.
Need to ensure those controls are shored up. What about opportunities?
The single biggest catalyst remains U.S. federal legalization or rescheduling. That would just unlock immense value and remove that punitive 280E tax burden. It's the elephant in the room.
Huge potential upside there.
Massive. There's also significant opportunity in continued international market expansion, especially medical exports. Leadership in the Netherlands market as one of only 10 licensed producers is a great position. And ongoing product innovation in new cannabis categories like edibles or beverages.
And the threats.
Intense competition and pricing pressure, that's ongoing in both cannabis and produce. Regulatory risk is ever present in all their key markets. Rules can change quickly. And competition from the illicit market, the black market, is still a factor stealing sales from legal players.
Okay, a clear picture of the internal factors. What about the broader macroeconomic and geopolitical landscape? How might that impact VFF?
Good question. First, inflation. As an agricultural business, VFF is definitely exposed to rising input costs, things like fertilizer, energy, labor. That can squeeze margins if they can't pass costs on.
Standard operational pressure.
Right, interest rates. Elevated rates increase the cost of capital if they need to borrow for expansion, and it makes servicing any existing debt more expensive. Less debt helps here, but it's still a factor.
And geopolitical factors, specifically those U.S.-imposed tariffs in 2025 on Canadian goods.
Interestingly, the report suggests these are unlikely to have a direct material impact on VFF's cross-border trade in produce and cannabis.
Oh, why is that?
Because these specific products generally fall under the USMCA trade agreement framework, which has critical exemptions. So they likely avoid those 25–35% tariffs directly.
That's a significant relief for them.
It is. The primary risk from tariffs would be indirect potential broader supply chain disruptions or just a general economic slowdown in North America that could dampen consumer spending on their products. But the direct hit seems unlikely based on USMCA.
Okay, that's good context on the external pressures. So we've covered the business, the management, the financials, the market view, ownership, and risks. Let's bring it all together. Finally, we arrive at Chapter 7. Conclusion, let's synthesize these findings.
Okay. The bull case for Village Farms rests firmly on the thesis that this company has successfully navigated a really tough transition and is now standing at a genuine profitability inflection point.
The corner has been turned, essentially.
That's the argument. It's supported by their proven low-cost operational expertise honed over decades. The successful strategic pivot from produce to high-margin global cannabis, that rapid international growth. Remember, medical cannabis sales up 690% year-over-year in Q2.
Astonishing growth.
Their unmatched U.S. optionality with Texas greenhouse footprint, the aligned and experienced management team with significant insider ownership, and importantly, that fortress balance sheet with low debt.
A lot of positives stacking up.
Definitely. But the bear case highlights significant risks, and you can't ignore them. That record profitability in Q2 2025, it's based on just one quarter. Its sustainability is totally unproven against that long backdrop of unprofitability. There's intense competition and pricing pressure, huge overarching regulatory uncertainty, especially around U.S. federal action, and ongoing execution risk with their big expansion projects. Can they manage that growth effectively?
So potential versus proof.
Exactly. And our educational discounted cash flow model, even with those conservative assumptions and the high 15% discount rate to account for risk, suggests an intrinsic value for Village Farms somewhere in the range of $3.57 to $4.50 per share.
So let's put it all together. What does this mean? As of August 14th, 2025, VFF's share price was $2.59. That's noticeably below our estimated intrinsic value range from the DCF. This valuation gap suggests that if management can truly sustain the kind of profitability shown in Q2, and if they can execute successfully on their global cannabis strategy, then the market might currently be undervaluing the company's long-term earning power and its unique strategic assets, especially that U.S. optionality.
There could be significant upside if things go right.
However, that gap, that discount, also appropriately reflects the very significant execution and regulatory risks inherent in this business and this industry. the market isn't giving them full credit yet, likely because of those uncertainties.
It's pricing in the risk, which is rational.
So it's a fascinating setup. A company with a unique history, powerful assets, strong leadership alignment, but facing industry headwinds and the crucial need to prove its recent success is sustainable. So thinking about everything we've discussed, what stands out most to you about Village Farms' journey from a traditional farm to the forefront of the cannabis industry? And maybe, what do you think is the single biggest factor that will ultimately determine its long-term fate?
Hmm. Great question to ponder. For me, it's that incredible leverage of their existing CEA expertise. It wasn't luck, it was strategy. The biggest factor. Probably successful execution of the U.S. market post-legalization. That's the multi-billion-dollar question.
It's definitely food for thought. If you found this deep dive insightful, please consider liking and subscribing to the Stock Analytics AI YouTube channel. It really helps us out.
Yeah, we appreciate the support.
And remember, members paying $4.99 a month get priority deep dives on tickers you suggest. Plus, over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those.
A huge project, lots of value there.
If you just want a one-off deep dive on a specific company, you can always drop us a super thanks on YouTube. And our standard disclaimer, this analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice.
Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us on the deep dive.